Coming up in today's show, stocks finish down to end the worst month of the year, inflation data comes in soft, the US government likely heads for a shutdown this weekend and what it means for markets, I look at upcoming seasonality, what Bill Ackman's saying about rates, what Dr. Copper is telling us about the global economy, and a look at this deeply undervalued stock I think may have bottomed today. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. My name's Jared. I'm going to get you all up to speed on the most important news, data and charts in the markets from today, and give you a bit of a month end and quarter end summary of what's been going on, and let you know where I think the opportunities and risks may lie. So both the S&P and the Nasdaq finished the month of September down over 5%. That was the worst month all year, and we finished on a bit of a bearish note overall today, with just a few of the mega cap techs holding up the Nasdaq a bit, and we saw the best performing sector of late, energy, have a little bit of a pullback here today, and continued weakness in those defensive sectors like healthcare, and financials a little soft as well. And just switching over to the heat map for the performance of September, you can see except for energy and a few individual names, it was mostly a down month across the board, with some pretty significant moves out there for some of the biggest companies like NVDA down 11%, Apple down 8%, Amazon down over 5%, and interest rate sectors like REITs, utilities, and tech in general came off pretty hard as we've seen bond yields rise. And there wasn't much of a defensive rotation overall. We did see some at the start of the month. However, overall, healthcare, consumer defensive, all finished the month lower. And stick with me today because I'm going to dive into some monthly technical analysis later on in this video. But let's first get you up to speed with all the most important news that's happening out there today. So we had some inflation data out early this morning, which initially got markets excited. And that's the Fed's preferred inflation measure, the Personal Consumption Expenditures Index, which showed the slowest monthly increase since 2020. And we can see a chart of the core PCE here, along with the core CPI, which has both been downtrending for over a year, but it's still well above where the Fed wants it at that 2% level. And that's why Jay Powell is keeping the door open on another rate hike. Even though they probably won't do it, I think they're kind of already on an unofficial pause. They just don't want to signal that to the market just yet. And so that PCE data came in a little lower than expectations. We can see the core PCE month over month growth was only 0.1%, a bit below the 0.2 expected. And same with the non-core price index, only grew 0.4%, a bit lower than the 0.5 expected. And so that data came out a few hours before the market opened, and the market initially liked that. We gapped up on the S&P 500 to a bit above 43.30. However, sellers were right there to take advantage of that and sold it right off into mid-afternoon, where we had a little bit of a bounce going into the close. However, as you've probably already heard, and what's capturing people's attention today is the politicians that are at it again, with more gridlock in Washington, and a shutdown come Sunday morning looks likely. Unless they can put together a last-minute temporary spending bill, the US government is likely to start next week's shutdown. And here's a look at some previous shutdowns and how long they last. The longest being in late 2018, which lasted 34 days, and the shortest being back in 95, which was 5 days. But usually it's a week or two before they sort it all out. And while some are saying this could cause a major financial crisis, and who knows, because there's a first for everything, markets are not all that worried about it, because looking back in history, the S&P 500 is typically held up pretty well and even rallied in periods of government shutdown. And that's because business goes on. People can still buy their products and services. It's just some public services that go on pause and create delays, and other things like getting your passport. National parks close down, but still essential federal workers will remain on the job. Economic data release could be delayed, and there could be some delays in food aid, US Postal Service, and so on. So it doesn't really affect markets all that much. And that's why we can see the VIX, although risen over the last couple of weeks, isn't all that high at 17.5. So that should be a nothing burger for the markets. And since we just had the last trading day for the month of September and the third quarter of 2023, let's just take a bit of a bird's eye look at the performances so far. So Dow Jones held up the best this month, only down 3.6%, but we can see the S&P, Nasdaq both down over 5%, and small caps, so the Russell down over 6%. And all main indices finished the quarter down between 2 and 5%. However, we've still got the S&P up 11.5% year to date, Nasdaq up 34% year to date, and the Russell pretty much unchanged there. Looking across sectors, no surprise the interest rate sensitive sectors, utilities, tech, real estate, finished the month of September the weakest as we got those rising yields, and the best performing sector was energy. Actually finished the month of September higher 1.5%, but still only up 3% year to date. Worst performing sector year to date is actually utilities, down 16%, and with consumer staples and real estate coming in second and third weakest. And we've still got tech, consumer discretionary, and communication services, with those indices mostly dominated by the mega cap tech, which is still showing pretty good year to date performances as well. And for those of you who regularly watch the channel, you know, I'd been talking about upcoming seasonal weakness as expected when looking through history, and we had a really good year-to-date performance coming into the third quarter. And we actually got a performance pretty much in line with history. Looking back on data on the S&P 500 going back to 1950, the third quarter in year 3 of the presidential cycle is typically weak performing. And over 70 years of data has only averaged 0.6% return for the third quarter, the year before a presidential election. However, going into the fourth quarter, that does prove substantially, with average returns coming in 3.5%. And so the bulls are pointing out that we're in some technically oversold conditions. Sentiment is pretty bearish, and then we've got this favorable seasonality coming up. However, this time might be different because we do have some different macro factors at play that are different to history, and that's namely rates and inflation and the relative valuation of stocks versus bonds. However, it can't be ignored that the fourth quarter is historically the strongest time of the year, and generally if the year-to-date performances have been pretty good, it increases the chances that we do see that Santa Claus rally, and we can start to see that seasonal strength right away in October as we get into Q4. And we can see in this bar chart here, the average performance for the S&P 500 in October has actually been increasing in recent years. So the blue there's from 1950, yellow's the past 20 years, orange is the past 10 years, and the grey's the past 5 years. So of course, Black Monday on the 19th of October in 1987, when the stock market fell 20% on one day, will have dragged down the average return in October going back in history. However, looking back in recent years, October can be one of the better performing months in the market. And so starting bullish seasonality in a technically oversold area can be a good setup, as we have seen a bunch of sentiment indicators showing extreme bearishness, like this here amongst the stock newsletter sentiment index. And typically when the crowd moves heavily to one side, that's a good contrarian signal. And I've seen the same thing in my own custom indicators looking here at the S&P 500. Got a little bit of evidence of dark pool buying, the most we've seen in quite some time, and my S&P 500 oscillator got a bit oversold there earlier this week. And so it wouldn't be all that surprising to see a bit of a bounce here in the market. However, I'm not convinced that bounce will turn into new fresh highs or even take out those highs from the start of the month, as I still think there's a good probability this bearish engulfing candle we got on the 27th of July could mark the top. But stick with me because I'll get into a bit more technical analysis on the monthly charts later on in this video. And the big structural headwind for stocks is the really strong rally we've got in bond yields, with the 30-year Treasury having its biggest quarterly gain in 14 years. And that's on the back of the federal government having to issue a record amount of debt after they hit a debt ceiling earlier on this year. They've already added more than $1.5 trillion to the federal debt load, and this is coming up to a time when a lot of corporates have to refinance as well, and it's just a simple supply and demand situation regardless of the Fed. If there's a lot of bond issuance, there's only so much investor capital out there, and all the issuers have to compete for that capital, and so then naturally the market will find a higher rate in order to get the bonds sold, so that's keeping upward pressure on rates. That's why I've got billionaires like Bill Ackman and CEO of BlackRock, Larry Fink, so they see the US Treasury yields hitting 5%, possibly in the upcoming weeks. And they're claiming persistent inflation will keep pushing interest rates up, noting that US yields in the 4% range are still low on a historical basis. And Larry Fink saying we're going to have 10-year rates at least 5% or higher because of this embedded inflation. He goes on to say this structural inflation is unlike anything, and I think business leaders and politicians are not providing the foundation to help explain this. We have not seen inflation like this in over 30 years. He even thinks the Fed funds rate could hit 7%. And there's a look at the 10-year yield today, closing at 4.57. And a look at the clean monthly chart. And the clear bull market that government bond yields are in doesn't show any technical signs of topping just yet. On the other side of the coin of that argument is another hedge fund billionaire, Barry Sternlicht, who says the Fed is throwing kerosene on the fire, needs to end rate hikes as inflation is probably already at 2%. Barry, who's into real estate, has been a loud critic of Fed policy for a while now. He said high interest rates mean the US is bound to enter a slowdown, and he argues that the surge in prices we saw was because of excess savings and spending from government stimulus and a lack of products on the shelves due to the supply chain restrictions coming out of COVID. But he's saying that's all reverse course now. Consumer savings are down and there's plenty of product on the shelves, and that should help keep downward pressure on prices and inflation. However, don't forget, everybody talks their own book, and as a real estate investor, I can imagine he really doesn't want to see higher rates, as that's going to keep eating into his yields. However, unless we do get a surprise and material uptick in inflation over coming months, New York Fed President John Williams may be right that the Fed is at or near peak rates, but it will hold for some time. So typically the Fed on average will hold for about 8 months after their last rate hike before cutting again. However, with this sticky inflation, they may hold rates a lot longer than usual. and that's something the stock market is unlikely to like. And so we've still got the core consumer price index, CPI, above 4%. I think the Fed would like to see that trending down below 3% before they can officially declare victory and say definitively they're on pause and position themselves for an upcoming rate cut. And so the US economy has been holding up a lot better than the rest of the world. And there's been something interesting happening in the copper market, which a lot of people will refer to as Dr. Copper, as copper is widely used in many parts of the economy. And so its price action can be somewhat predictive of the future of the global economy. And what we've been seeing is a really steep contango in the curve of copper futures, and that's when the spot price, which you could think of as like the current price, if you were to buy some copper at the spot, that's the immediate price for immediate delivery, and the difference between the spot and the price out in the future, and hence the term futures. So if you were to buy a futures contract 3 months out, 6 months out, a year out, that's an agreement today for a price you'll pay in the future and take delivery for. So contango means that the price out in the future is a lot higher than spot. And we've seen the widest spread between spot and future prices in copper in over 30 years. And so basically that's a lot of selling going on right now in copper. And that could be to do with the weakness in the Chinese economy. And we've seen an increase in the amount of copper being stored in exchange warehouses around the world, currently just below 164,000 tons. And that's an increase of 50% since the start of September. And basically that's just a really clear signal of weakening demand, which is not what you want to see in a growing global economy. If all engines are firing, we should see a lot of buying of copper. And here's a look at a clean weekly chart of copper futures. And we can see this year been in a bit of a soft downtrend and still well off their peaks early last year. And the spread I like to follow is copper versus gold, because you can kind of think of copper as a growth commodity and gold as a defensive commodity. And that's also been in a downtrend for a couple of years now as well. And crude oil finished the day lower, but actually finished the third quarter this year up a strong 29%. That was the back of tightening supplies coming out of Saudi Arabia, Russia, US crude supplies being at 40-year lows. However, oil may be due for a bit of a pullback, as like we've seen in copper, global growth ain't all that strong, and like we saw in the PCE index today, inflation's coming back a little bit, and the Saudis and the Russians could very well likely come out in the next month or so, confirming their production cuts will end December, and they might want to see oil back in the mid-80s. And here's a look at the daily chart of crude oil futures, which have been on a pretty solid uptrend. However, just looking at the weekly chart, we are getting a little technically overbought up here. So I'd say we could have a bit of a pullback over the coming week or so. However, I still wouldn't rule out $100 a barrel in oil at some point over the coming weeks and months. However, that could prove to be the top of the range for a little while, as we'd really need to see global demand and economy pick up to see crude hold over $100 a barrel for any extended period of time. We've also got the CEO of the third largest US bank by assets, Citigroup, Jane Fraser, saying she's seeing cracks emerging among some consumers as savings dry up. And she's saying consumers with low credit scores are already having a hard time. And that's on the back of excess savings from COVID years drying up and a bit of tightening from the banks. Ever since we had those regional bank failures back in March, we've seen the amount of people being denied credit increasing. And that's at a time when unemployment rates are still really low. And just a quick look at what's coming up next week. We've got some manufacturing and construction economic data due out Monday, jobs job openings on Tuesday, with more labour market data coming out Wednesday, the usual weekly jobless claims, and then the big one Friday, non-farm payrolls. First Friday of the month that we get that data, and the market's expecting 163,000 new jobs to be created for the month of September, which is down on the previous month of 187,000. And just looking at a 3-year chart of the non-farm payrolls, we can see that's been in a steady downtrend since early 2021. There's a look at corporate insider activity. Not doing a whole lot of trading here. Normally corporate insiders will buy the dip when we see weakness in the market. They haven't really been doing that lately, and they'll normally won't do as much selling into weaknesses as well. And so in today's episode, I wanted to bring to your attention a stock I think is deeply undervalued and may have potentially bottomed today on a strong technical signal, and that's Walgreens, which all Americans will know. And for my non-American viewers, Walgreens is basically a retail pharmacy drugstore that you'll find all across America. They've got 9,000 stores. And just taking you out to a monthly chart on Walgreens, we can see the stock price peaked way back in 2015, just under $100 a share. It's actually fallen about 78% in that time. And that's due to a few things like increased competition from Amazon, increased cost and labor. They had some litigation claims related to the opioid crisis and had to pay out for that. And just the general pressure on brick and mortar stores from online competition and the big cost base that they have. And they did have a bit of a debt load over that time. However, I think that's under control because their debt to assets is currently at 66%. Which is not too crazy or dangerous. And we can see over the last 5 years, revenues remained relatively stable, around 120, 130 billion per year. And just technically speaking, just looking on the monthly chart here, you can see we're below the buy-sell band and the oversold area on the DSI. indicating we're really technically oversold in the long term. And just looking at the daily chart, we can see a big bullish divergence on my DSI, the hidden divergence indicator, and then we've got this big green shoot of a candle today, indicating potentially big money is coming into the stock off these lows. And I can see the same trend in my dark pool indicator. A lot of accumulation going on over the last couple of weeks down here. And something else that caught my eye and is of note is we've seen a bit of insider buying in Walgreens this year. And that was after we had 2 large insider sells last year at around $40 a share. Back in March this year, the CEO actually picked up 10,000 shares, just below $34 a share, for about a 340 grand purchase. And at the end of June, we saw another insider pick up $146,000 worth of shares at $28 a share. And regular viewers know I follow insiders because no one knows the company better than they do. And they're typically savvy individuals making really good financial decisions. And so they wouldn't sink significant parts of their own wealth into the stock if they thought it was going to go bankrupt. And so that gives me a little bit more conviction as well that Walgreens in the low 20s could prove to be a really good risk reward. And on my stock fair value indicator, it's got fair value just above $50 a share, indicating the current price at $22 a share is 55% undervalued. And my business quality score indicator has a healthy reading above 11 as well. And so while this stock has been written off by most of the market, I think there is a potentially good risk reward here. And of course, all investments come with risk. However, the good thing about stocks is they can't go below zero. And so your maximum risk will always be $22 per share. And just looking at a monthly chart, I would say there's potentially more upside over the coming years if they can turn it around, get a little bit of growth happening, or even retain their really high dividend yield. Because at a current market valuation of $19 billion for a company that has 9,000 stores, that it comes out to about $2 million per store. And so in my opinion, the long-term value of each of those stores could be worth a lot more than $2 million. And I guess it's just a bet on whether people are still going to visit physical pharmacies and drugstores in person, or do you think it's all going to be done online? Personally, I think there'll always be a need for physical drugstores, as quite often when people are sick, they don't want to wait for something to be delivered. They just want to go out and get it straight away. And a lot of their stores are often placed in places of convenience with a lot of foot traffic. And of course, they sell a lot more items than just drugs as well. So I still think Walgreens is going to be around for many years, and accumulating shares in the low 20s could prove in the long term to be a bargain buy. So if you haven't already, subscribe to this channel and I'll keep you updated on this stock going into the future. Okay, diving into the charts and taking you across the rest of the financial markets and what's going on out there. International stock indices were mostly flat to finish the week. We've still got China at the bottom of this range trying to find support here, and the third largest market in the world, Japan, coming down to its support as well. There's a look at the volatility market with the term structure pretty flat here, and stock market breadth fell again to finish the week. We are getting pretty low here on the amount of stocks above the 50-day average, 14%. And this can be an area where you see a bit of a bounce in the stock market. Things get a bit oversold. We did see a bit of improvement today with the amount of stocks making new lows. On the NYSE, in recent days, we had been seeing that number get above 100, but we finished today just 43 stocks making new lows and 69 on the NASDAQ making new lows. Mega cap tech still holding up the growth defensive sector spread. Same with gross versus value, and those inverted treasury yield curves keep moving on the way back to zero. Short-term yields are still holding strong over 5%, and we just got a reversal signal on TLT. It's trying to find support down here, which has been technically oversold as well. And a little bit of weakness in high yield bonds, currently sitting at the bottom of this range we've been watching. There's the dollar index, which actually slipped to low 105s today before it was dip bought, and nothing too exciting happening in Bitcoin. Commodity index had a bit of a pullback today, along with gold, which is getting a bit technically oversold here. Now down to minus 17 on the DSI, and what I'll be looking for is this support zone around 1830 to hold, just taking you out to a weekly chart. That's a price level where we've seen a few turns before. Namely, back in February, we got a nice bounce off that level. But that's got a strong dollar and yield as a big headwind for gold. And there's uranium coming off a bit today, down 3.5%, as that may have got a bit technically overbought. And over to stock sectors, was a bit mixed out there today. Cannabis ETF still holding above its 50-day. We may get a big move in either direction next week as we get more news and updates on legislation trying to make its way through Congress, and we'll just have to wait and see whether the politicians can do the right thing or if they continue to bow down to their big pharma corporate sponsors. There's one of the best performing sectors this year, semis, still having a hard time to get above its 50. Same with home builders as well, in a short-term downtrend. Fresh equity in the market, as measured by the IPO ETF, not doing too well. Same deal with industrials and financials as well, still looking weak here. And there's that pullback in energy stocks now, sitting at the 50-day VWAP. And we may get a bit of a pullback here after the good performance we've had the last couple of months. And there's a look at the interest rate. Sensitive sectors, REITs, been hit hard this month, along with utilities, which is looking pretty technically oversold here. We just got a reversal signal, and I'd say we could get a little bounce in this sector next week. JP Morgan did a big bearish engulfing candle today, and Apple just trying to hold on here above $170. Same with Microsoft, kind of just drifting, and NVDA and Tesla as well. Over to meme stocks, was a bit mixed out there today. We actually saw some good moves up across the board. And then cruise operator Carnival came out with earnings, bit of a beat on the bottom line. The market wasn't too excited by their outlook and finished the day about 5% lower. And there's an update on Celsius Holdings. Those of you who watch my channel remember on the 15th of September will remember me saying I added this as a short position to my Only Bears portfolio, just below $200 a share, and that looks to have already broken down and holding below its 50-day VWAP here. And I'm still holding this position short, as I think its fair value is more closer towards $70 a share. We got Nike's earnings yesterday, and they came in with a pretty good beat on the bottom line, and we got a bit of a dead cat bounce. Market gapped up above its 50-day, but was sold off. Still finished the day up over 6%. And the regional banks continue to drift sideways, with a bit more weakness in the bigger guys, Bank of America, Citi, Wells, and Schwab as well, which may be a little bit technically oversold. Okay, just to give you a bit of look at a clean monthly chart of S&P 500. One could argue that what happened last year wasn't a bear market, but simply a correction in this big secular bull market we've had since early 2009. However, this could be setting up a potential double top here. You can see we're right on this trend line here, and typically double tops, they don't have to come right up to the first point where it made it top. It can sometimes fall short or go a little bit further, but right now we have to say we're in a sideways market. We need a lot more confirmation on the downside to say that we've got a bit of a resumption of a downtrend. So we're just kind of middle ground here, and just looking at the S&P 500 equal weight, you can see it's a bit more softer and sideways action, and the Nasdaq double top pattern's a bit more pronounced. And there's a look at the Nasdaq equal weight, a bit softer again, so it's really been the Magnificent 7 mega cap tech holding those indices up. There's a Dow Jones Industrial looking a bit flat and potentially a bit toppy. Mid caps is a bunch of mess as well, and the smaller we go, the weaker we go. The Russell 2000 hasn't even managed to come up nowhere near its 2021 peak, and micro caps actually look to be breaking down to fresh lows. So the breadth out there in the market is still really weak, and like I've been saying, it's hard to call this either a bull or a bear market. It's more of a messy sideways market. Okay, so to sum it up, we have been pretty technically oversold this last week. There are some signs that we could get a short-term bounce on sentiment, and in my technical indicators, the government's likely to go into shutdown on Sunday, but the market's not too worried because that normally doesn't affect markets too much. We got a little bit of a pullback in oil and yields back on that inflation data, and that could help to give the equity market a bit of a bounce next week. And we'll be expecting non-farm payrolls, the job market, to come in line, with the job market still holding up. But I'd still be surprised to see the S&P trade above 4,500 and hold there for long. And just looking at a weekly chart, I think we could go into a period of chop and a bit of a range, as we do have that bullish seasonality coming up in the fourth quarter. And I still think we're kind of just in this sideways market where you can't really definitively call it either a bull market or a bear market. And that could go on for some time yet. But that's all for today. Thanks very much for tuning in to Click Capital. I hope you all have a great weekend, and we'll see you again Monday afternoon. Cheers.